Marriott had excellent results in 2024, reflecting continued robust demand for customers, owners, and franchisees for our more than 30 brands. For the full year, we achieved net rooms growth of 6.8%, and global RevPAR rose over 4%. We ended the year on a high note, with fourth quarter worldwide RevPAR increasing 5%. ADR rose 3%, and occupancy increased over 1 percentage point. All of our regions produced better RevPAR growth than we had previously expected, with strength across all of our customer segments. The U.S. and Canada saw its best quarterly RevPAR growth of the year, with fourth quarter RevPAR rising over 4%, primarily driven by a higher ADR. The drop in occupancy around November's U.S. election was not as severe as we had anticipated, with demand rebounding quickly after the election. International RevPAR rose over 7% in the quarter, driven by 4% rise in ADR and a 2 percentage point gain in occupancy. APEC RevPAR increased 12.5%, led by strong growth in Japan, India, and Thailand, and aided by strong cross-border demand, especially from Greater China. RevPAR in the EMEA region rose 8%, with broad-based growth across the region, led by strong leisure demand. RevPAR in Greater China declined 2%, better than prior expectations, as the region benefited from the recent expanded visa-free transit policy and better than anticipated demand across multiple holidays and citywide events. By region, RevPAR growth was positive in Tier 1 cities, Hong Kong, Macau, and Taiwan, while Hainan Island again saw the largest RevPAR decline. Hainan was again impacted by weak domestic leisure demand as wealthier travelers continued to vacation across other parts of the region. However, Hainan did see nice sequential improvement, with RevPAR down 16% in the quarter compared to down 24% in Q3. Turning to trends by customer segment, leisure, which comprises the largest portion of global room nights at 44%, had its strongest RevPAR growth quarter of the year and was the fastest growing of our customer segments. Fourth quarter leisure RevPAR rose 6% globally and 4% in the U.S. and Canada, driven by gains in both room nights and ADR, with strength across all tiers from luxury to select service. Business transient contributed 33% of global room nights in the fourth quarter. Solid gains in ADR drove business transient RevPAR up 3% globally and up 4% in the U.S. and Canada. Group RevPAR, which comprised 23% of room nights, rose 3% in the quarter. As expected, this was group's lowest growth quarter of the year due to fewer group events in the U.S. around November's election and a decline in group RevPAR in Greater China. Looking at full year 2024, all customer segments experienced solid RevPAR growth on a global basis. Group increased an impressive 8%, and leisure and business transient rising 3% respectively. As Leeny will discuss during her remarks, we are pleased with the solid momentum we have in our business as we start off 2025. At the end of 2024, global group revenues were pacing up 6% for 2025 and 10% for 2026 on increases in both room nights and average daily rate. Shifting to development, 2024 was another terrific year. Net rooms grew 6.8%, helped by the addition of around 38,000 rooms from our agreement with MGM and approximately 9,000 rooms from Sonder. Conversions were again a large driver of growth in 2024, contributing about a third of our signings and over half of our openings. Our industry-leading global lodging portfolio now boasts over 1.7 million rooms across 144 countries and territories. With a record of over 1,200 deals signed last year, We ended the year with over 577,000 rooms in our pipeline. In the U.S. and Canada, our largest market, we led the industry in gross room additions, with around one-third of all rooms opened during the year flying one of Marriott's flags. While financing in the U.S. remains particularly challenging for new construction, we also had the leading share of new build construction starts in 2024, as banks have shown preference for deals associated with our strong brands and an experienced player like Marriott. During the year, we also meaningfully expanded the breadth and depth of our portfolio across customer tiers, from luxury to mid-scale, and across both traditional and alternative lodging product offerings. We continue to have strong owner interest in all of our mid-scale brands, given their compelling brand design, the power of our revenue engines, and their simple bundled affiliation costs, which we believe are the lowest in the industry. At the end of the year, we had over 300 open and pipeline 4 Points Flex, Studio Res, and City Express by Marriott properties just a year and a half after entering the mid-scale tier. We also continue to expand our incredible luxury portfolio with the opening of several notable hotels, including the St. Regis on the Bund in Shanghai and W's in Prague and Sao Paulo. In the non-traditional lodging space, in December, we announced our plan to launch an outdoor-focused collection, which will be anchored by founding deals with Postcard Cabins and Trailwalk, two innovative outdoor hospitality brands. Ilma, the second luxury super yacht in the Ritz-Carlton Yacht Collection, had its maiden voyage in the Mediterranean last September, and our third super yacht, Luminara, is expected to set sail this summer, with itineraries in the Mediterranean, Asia, Alaska, and Canada. Our focus on offering fantastic travel experiences for every trip purpose is key to ensuring that Marriott Bonvoy remains the industry's leading travel platform. We added over 31 million new members to our loyalty program last year, growing to nearly 228 million members at year-end. Bonvoy member penetration of room nights achieved historic highs in the fourth quarter, at 73% in the U.S. and 66% globally. As we grow that member base and our global portfolio and add travel-adjacent products and collaborations, like our 33 co-brand credit cards and tie-ups with partners like Uber and Starbucks, we are deepening engagement with our members and capturing more of our customers' share of wallet. Driven by a strong increase in global card spend, our co-brand credit card fees rose nearly 10% last year. Our digital channels, and mobile in particular, remain key drivers of direct bookings at a lower cost to our owners. In 2024, Marriott Bonvoy app downloads rose nearly 30% year over year. We're excited about enhancing the customer experience across all our digital channels through the multi-year digital transformation we have underway that we expect to begin rolling out a little later this year. Before I turn the call over to Leeny to discuss our financial results in more detail, I want to thank our teams around the world for their hard work and dedication, and for making Marriott a place where innovation and excellence thrive. Leeny?
Thank you, Tony. I'll start by reviewing our solid financial performance. Fourth quarter total gross fee revenues grew 7% to $1.3 billion, primarily due to higher RevPAR, room additions, 13% increase in credit card fees, and a near doubling of residential branding fees. Incentive management fees, or IMFs, decreased year over year as strength in APAC was offset by declines in Greater China and in the U.S. and Canada. The decline in the U.S. and Canada was primarily driven by lower fees in Maui, given the timing of fee recognition in the prior year. G&A declined 12% year over year to $289 million, primarily due to lower administrative, bad debt, and litigation expenses. Fourth quarter adjusted EBITDA grew 7% to $1.29 billion. At the hotel level, profit margins at our worldwide managed hotels rose 110 basis points in the quarter and 40 basis points for the year, helped by continued productivity improvements. We were also pleased that our guest surveys indicated that customer satisfaction continued to rise, with our 2024 intent to recommend scores increasing in every one of our regions. For the full year, gross fees and adjusted EBITDA both increased 7%. We were pleased that with the power of our strong cash-generating, asset-light business model and our disciplined investment, we returned over $4.4 billion to shareholders through a combination of dividends and buybacks. I'll now talk about our 2025 expectations, starting with net rooms growth. With our industry-leading pipeline and strong momentum in conversions, we expect net rooms growth of 4% to 5%. Conversions, of course, can enter the system quickly. Conversions that were added to our system in 2024 had been in the pipeline for 14 months on average, and nearly 20% of conversions opened so quickly they were not in any quarter-end pipeline number. Over the three-year period from year-end 22 to year-end 25, we continue to expect net rooms to grow at a compound annual growth rate of 5 to 5.5% we discussed at our 2023 investor meeting. For full year 25, we expect global RevPAR growth of 2 to 4%. With the exception of Greater China, RevPAR growth in international regions, though continuing to normalize, is again expected to be higher than in the U.S. and Canada. We currently anticipate RevPAR in Greater China to be roughly flat year over year. As Tony discussed, we're off to a great start, with January RevPAR rising 6% globally. The sensitivity of 1 percentage point change in full year 2025 RevPAR versus 2024 could be around $50 to $60 million of RevPAR-related fees and $5 million in owned leased profits. For the full year, gross fees could rise 4 to 6% to around $5.4 to $5.5 billion. Co-brand credit card fee growth could be a couple hundred basis points lower than the nearly 10% growth in 24, primarily due to the normalization of international card fee growth. Residential branding fees could decline nearly 50%, solely due to the timing of unit sales, while timeshare fees, as usual, are expected to be relatively in line with the prior year at around $110 million. FX is expected to negatively impact gross fees by roughly $25 million. Owned leased and other revenues net of expenses is expected to total $345 to $355 million, relatively in line with 2024's results, somewhat impacted by a larger number of renovations at our owned and leased hotels. 2025 G&A expense is anticipated to decline 8 to 10% to $965 to $985 million. This decline is the result of the expected $80 to $90 million of above-property savings from our enterprise-wide initiative to enhance our effectiveness and efficiency across the company. As we previously noted, this process should also yield cost savings to our owners and franchisees. In December, we announced that we would reduce our loyalty charge-out rates by roughly 5%. Full-year adjusted EBITDA could increase between 6 and 9% to roughly $5.3 to $5.4 billion. Full-year adjusted diluted EPS could total $9.82 to $10.19. EPS growth will be impacted by an expected effective tax rate of around 26%, compared to under 25% in 2024, reflecting certain international tax rate changes. Our underlying core cash tax rate is anticipated to remain in the low 20% range. For the first quarter, global RevPAR could increase 3 to 4%, benefiting from Easter shifting from March to April this year, as well as January's inauguration and the Super Bowl in New Orleans, benefiting the U.S. and Canada. First quarter gross fees could increase 2 to 3.5%. Solid growth in management and franchise fees are expected to be partially offset by a decline in IMFs, partly due to a decline in Greater China, given their strong first quarter a year ago, as well as certain properties in the U.S. and Canada undergoing renovations. First quarter owned, leased, and other revenues net of expenses of around $55 million is expected to decline year over year, primarily due to the Elegant portfolio undergoing renovations, as well as the timing of termination fees. We expect $1 billion to $1.1 billion of investment spending in 2025. There are three major areas of expected spending that are each around a third of this total. The first bucket is another year of higher than historical investment in technology. Over half of this investment is associated with the multi-year transformation of our property management, reservations, and loyalty systems, the overwhelming portion of which is expected to be reimbursed over time. The second bucket is spending for our owned lease portfolio. This spending is expected to be above historical levels in 25, with about half of the expected investment driven by the completion of renovations on the Elegant portfolio in Barbados, as well as renovations on a handful of other hotels. We expect to sell the Elegant portfolio after renovations are complete, subject to long-term contract to remain in our system. The last bucket is expected investment in our contracts, largely for new units as we continue to expand our global portfolio. Our capital allocation philosophy has not changed. We're committed to our investment-grade rating and investing in growth that's accretive to shareholder value. Excess capital is returned to shareholders through a combination of share repurchase and a modest cash dividend, which has risen meaningfully over time. In 2025, we expect another year of strong capital returns of approximately $4 billion. Full guidance assumptions and details for the first quarter and the full year are in the press release. Tony and I are now happy to take your questions. Operator?